Welcome to Nasdaq TradeTalks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you from Global Alts Miami by iConnections, and joining me for this segment, we have Gleason. He's Portfolio Manager at Octagon. We're here to discuss the CLO market and what's attracting new investor segments. Sean, it is great to have you with us. Welcome to TradeTalks.
Than's for having me.
It's interesting, the CLO market is off to a great start in 2025. What's your outlook for issuance this year? What are your views on primary equity at these levels? We haven't spoken about CLOs as much as we have been recently.
Yeah, no, it's a great question. And the CLO market in general has really grown, and it's now actually an over $1 trillion market. Last year was actually a record year of issuance across the CLO space. I think part of that is we continue to see different investor channels, including retail, show interest in the space. And part of it is just cycle-tested performance over many different cycles. So as you noted, January is off to a robust start, and we expect another year of record issuance like we saw in 2024.
And you brought up ETFs as an example here. Tremendous growth over the past 12 months. Retail investors, advisors are comfortable with that wrapper. They understand it. How does this impact the market itself, and does the new investor segment create concerns or opportunities around that?
Yeah, no, I think it's really part of the institutionalization of the asset class. An asset class of this scale, with this performance track record, has drawn channels that historically haven't been part of the asset class. So we think it's overall great as a manager of CLOs to have additional demand. And in terms of opportunities, one thing we do in some of our other strategies is names and credits can move based on retail flows. And so over time, as that develops, we'll certainly look to be tactical if that presents opportunities.
Public and private credit markets are continuing to converge. Yeah. We're hearing a lot of investment within that space. And of course, with alts, there's a number of subsectors. So where are the opportunities for managers like Octagon, who historically have been bigger players in the broadly syndicated bank loan market?
Yeah, so Octagon is a $33 billion or so asset manager, historically have been on the broadly syndicated side. But as we talk to sponsors are increasingly looking at their largest lenders and not looking at it as public versus private, but who are some of our largest lenders, who has lent to us through different cycles, who can be constructive in pricing risk. And so what we continue to see is deals actually move between asset classes. And fundamentally, you're underwriting U.S. corporate credit. And so we think we'll continue to see deals that are in the public, and then maybe they trade hands to a different sponsor, or they have a different business strategy or outlook and move to the private, and vice versa. And so actually one of the bigger opportunities we've seen over the last year and expect in 25 is that we'll continue to see deals migrate from the private market into the public market, which would be considered a true new issue in the public market. But it's a little interesting because you're actually underwriting a deal that already has a track record.
Which seems to be a consistent theme this year, just because the space is evolving in a very different way. And you mentioned the CLO market, it's $1 trillion today. So let's pull the layers back for a moment here. Your conversations with investors, why is that demand increasing? Are they looking for a way to basically decouple from the traditional 60-40 portfolio to find less correlation among their asset classes? What do you think is driving this increased interest?
Yeah, I think it's a couple things. I think one, CLOs being a floating rate asset class, you're obviously protected against duration. Two, the product has now performed through the great financial crisis, through COVID, through some of the supply chain disruption. So you continue to see good credit protection and a little bit better yields than what you maybe have in some of your more traditional asset classes.
So I'll ask you this in a different way. And we've been speaking to a number of providers such as yourself throughout the conference here. It seems as if the impact from what's happening from the macro environment isn't necessarily, it's impacted in a different way in the alternative space. It's probably not as extreme or as impacted by the headlines, if you will.
Yeah, no, that's a great point. And so if you think about the portfolio of the borrowers we're lending to, they're very representative of the U.S. economy. So our largest sector exposures are software and healthcare, but it's really diverse, and these are larger scale, well-known businesses. And obviously the U.S. economy right now is performing quite well, and we continue to see our borrowers perform well. So when you look under the hood at the fundamentals, there's actually a pretty good story. And then with base rates no longer so low and probably remaining at a higher level for longer, you're able to get yield with the underlying portfolio of actually really quality U.S.-centric borrowers.
What's the flip side of that? What would impact them as you're thinking about risk in your portfolio?
Yeah, absolutely. So there's always individual credit risk, and so that could be a business that is seeing secular headwinds or a business that maybe set up their capital structure at a zero base rate environment that is struggling with these higher interest rates. And then just like any other market, we are impacted by overall macro conditions. And so spreads are tight right now, yields are interesting, but whenever spreads are this tight, you have to be cognizant of any sort of exogenous shocks or surprise, and then be prepared to tactically rotate your portfolio accordingly.
All right, Sean, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from Global Alts. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.